Good morning, everyone. Thanks for joining us today. Today's webinar is Mastering Market Data for Trading Excellence. And today's webinar is going to be presented by two very, very important people at ITRS. First off, we've got Dave Randall.
Hello.
And we've got Rodney Taylor. So just a little intro.
Thanks, Angelo. Thanks, everybody, for joining today. I'll give a brief introduction to myself. So I'm Rodney Taylor. I manage the Global Partners team here at ITRS. That's not really the reason I'm on this call, though. It's less about partners and more about the years that I have spent working in market data at some big market data companies like LSEG for more years than I care to state on this call. I am joined by a man who many would say needs no introduction, but nevertheless, I'm going to ask him to introduce himself, Mr. Randall.
Good morning, David Randall. I'm the Global Head of Sales Engineering at ITRS. I've been here for 13 years. Been in the industry, in the financial industry, working with the tier ones for over 30 years. So I think between myself and Rodney, hopefully we should give you a bit of an idea of what we're going to talk about with market data.
So that's a combined 31 years. So just to go through the agenda today, we are going to try and aim to talk a little bit about how monitoring of market data can help with overall trading performance. So we're going to do a little bit of scene setting, talk about some of the trends in market data at the moment and why this is important. Also kind of what we really mean by advanced market data monitoring, so the sorts of things broadly that Geneos is capable of. And then we're going to try and delve into some real use cases and talk about how you can reduce risk looking at things like raw latency or relative feed performance, and even delving right down into the weeds and looking at some examples of some data quality monitoring that you're able to do with Geneos. So there's probably, I think most people would agree, and this is not news to anyone on this call for sure, or anyone that works in the market, that the two big trends over the last few years, and certainly continuing for the next few years, has been the growth of AI. So lots of vendors of trading applications now trying to understand how they can integrate AI into trading applications, whether it's machine learning or similar things. And also alongside that, the other big theme is obviously cloud adoption, people moving to either SaaS services or to hosted feeds. So these two themes kind of coming together to ensure that there's a lot of change going on within the marketplace at the moment. There's always a lot of change, and I think the three V's of market data, the increase in variety, velocity, and volume, have been around for a long time. But what we're seeing now is larger data sets being hosted in the cloud, making it cheaper and easier to access them, which is really accelerating that variety of data. And the advent of things like AI is making both structured and unstructured data much easier to read, which is adding to this volume. And of course, there's always a constant drive to lower latencies to reduce market risk. So these themes, I could have spoken about them 10 years ago. They're still big themes now, I think. And certainly a lot of the organizations that we speak to are still wrestling with this. Inevitably, when new technologies or new methodologies of storing data are kind of being adopted, it introduces risk into your systems. And we've been there for our customers and partners to help reduce that risk. And that's what we're going to talk about today. Dave, I'm sure you see some practical examples of this at our customers currently.
Yeah, I think everyone's aware that the discussion has been going on for a number of years, as you say. I mean, and a lot of the companies we're dealing with now are rising to that challenge, which will add a lot more complexity, which had a lot more steps in the path. So I think at an FSD event last week, we had Exergy talking about their cloud adoption, how they're going to live market data feeds from the cloud. So they're kind of already putting their hat in the arena. You've got LSEG, publicly have issued that they're working very closely with Azure to try and do that. You've got the NASDAQ, again, they're working closely now with AWS. And for futures and options, the CME, they've gone to the Google. So everyone is kind of aligning to their different vendors. I think everyone's in this race to be kind of like the first, or to have this kind of adoption, which is very much the industry will benefit from. But again, adding that extra layer does add extra layers, as you say, of risk, complexity, and how that data is there.
Yeah, thanks, Dave. And I think it's these kind of complex hybrid environments that are fast moving is what we've always been known to help with. And so from a technical perspective, there's not a bank around, there's not a trading firm around that hasn't invested heavily in disaster recovery and making sure that they're resilient inside and outside of the data center. Having sort of primary and secondary feeds is obviously a long-term mainstay of capital markets. Trying to have constant availability of trading services has always been the aim, and lots of banks kind of measure themselves over multi-year periods of zero downtime. And we've been there on that journey, obviously, with Geneos. That those kind of real-time monitoring of hybrid real estate has been our bread and butter for a long time. But there's maybe been a little less focus on the performance of the actual market data feeds, and maybe less well known is how Geneos's market data monitor, MDM, can be used to actually achieve optimal performance across the feed. So it's not just about feed A has failed, let's go over to feed B, but of the different data sources that I have right now, am I using the optimal price source for my trading performance to make sure that my price formation is not based on stale data or incorrect data? And so that kind of move from just purely technical monitoring to also data monitoring is what we kind of want to hone in on today. And Dave, I'm sure you've kind of worked on some practical examples with customers already of this.
Yeah, I mean, I think working both for tier ones and obviously for ITRS, obviously we've got a greater kind of awareness of how people are using this. So I think the standard theme is generally people have a primary feed or a primary vendor feed that comes in. That's generally their kind of favoured feed. And I think for the sake of compliance, for the sake of resiliency, just to kind of have that additional feed in the event that there is a major issue, they had that secondary feed. Is it being used? Are people aware, in real time from a day-to-day perspective? Is one feed tracking against the other feed? Not so much. People are more kind of focused on, have I got a feed of data? Am I getting that constant feed coming through? The variance in that data and the kind of visibility and awareness of that data is not so much, but I think with this move to the cloud, again, I think there's a lot more focus on this. So for the consumer of this data, I think definitely it's going to benefit them in the sense that there's going to be a lot more focus now on what these vendors can do from a cloud perspective and how much quicker they are than the next one. So I think it's great. From a market data perspective, from Geneos, from the market, the good thing is there is no real change to this. The fact that we can just consume that feed, whether it's coming from the cloud or whether it's coming from a SaaS solution or internal, makes no difference whatsoever. So that's so you can mix and match that. It's a kind of hybrid of how that works.
Perfect, thanks, Dave. So let's drill into a couple of use cases then. So essentially what we can do with Geneos MDM is have a look inside the data packets at any of the data fields and publish those fields out so that you can run some mathematical calculations. So anything mathematical you can think of, you can run across those fields. So the obvious one here is timestamps. So from a raw latency perspective, I know what time the market data has been published at because that's included in the market data feed. I also know what the time is now. So at its simplest form, taking the current time away from what the published time was gives me a raw latency reading. Now, as a standalone data point, that's maybe not that interesting because obviously a whole bunch of that latency is outside the firewall before it gets to me. There'll be lots of hops and data centers and pops before it gets to me. So as whether a single point in time latency measure is useful depends on lots of things that I have no control over. But certainly what is interesting is having a real-time view of what that latency is doing over time. So what I certainly do want to know is a feed slowing down? Is it stale? Is it getting quicker over time? Maybe I might want to know. Might want to know that that the investment I'm making in technology and that my vendors are making in technology are improving the performance of the feeds. And certainly exchanges and vendors will use this type of stuff themselves, like even internally, taking timestamps, for a normalized or a standardized feed. I might want to know, how long is it taking me to get that data and publish it back out to the market, and am I being timely? But understanding over time how my feed is performing is something that we can do with Geneos MDM.
And I think, Rodney, I mean, there's a number of things you mentioned there, right? There's an array of use cases you've mentioned there. I mean, just to kind of drill in a few there, just to kind of overarch what you're trying to say as well, is with this data, Rodney said we can get any field in a packet that comes along, which is brilliant. However, there might be data that I want to calculate, and I want to get derived data. So as Rodney mentioned there, it's important to remember that not only do we get the information that's supplied by the provider, by the feed provider, but also we can derive data based on some kind of calculation, whether it be a skew data, what's the variance. I can start adding my own calculations on that. Now, in order to do that, I need to do that in real time, which is what MDM provides for you and Geneos provides. In order to start looking at trending, which Rodney talked about, not only my historical trending, look at my behavioral patterns that shape my data. Does it get slower? Does it get faster over time? But also, are there certain patterns, as in at certain times of the day, does it get slower? And do I need to look at that? Now, if you're looking at it in real time, you wouldn't necessarily kind of see that. But by looking at kind of that historical relative understanding of that data, you can then start to see the patterns emerge, and you can then overlay the real-time data against that shape of the data, what my variance is. And we'll talk a bit more about that later. But in order to do that, as well as predicting when it's going to hit a certain point based on the historical information, I need to store that data. So Geneos does have the capability to store all of this derived and latency data at scale. So we can do that and do the calculations and do the variance on the real-time data coming in against the historical data.
Yeah, I really like that as a use case. This idea that you're gonna get alerted before the market even realizes that something's happening, because you're constantly sampling this data on a second by second, 5-second basis. And so if there is a slowdown, if there's a market slowdown, you're going to get an early warning signal. And when this becomes really interesting is not just the raw latency, but also the relative latency. So if I do these raw latency measures for both my primary feed, secondary feed, tertiary feeds, however many sources of data I have for similar data fields, we can then take whatever I consider my primary source, whatever I consider my primary feed, as a baseline. So that's my zero latency, because it's my primary feed. And I can constantly measure how my other sources are performing against my primary feed. So this gives me this kind of immediate view of not just the raw latency and the movement of the latency, but also the relative latency of different providers. And I think it's really at this point you can start thinking, does it need to be a total failure of technology for me to move to a secondary source? Or are there actually just optimum times in terms of performance that I want to know about, that I want to use a secondary source to base my trading information and decisions on? And so we're going to show you how you can take this latency baseline and have a look at relative feed performance in a demonstration.
We are going to see that, and we're going to show a few more kind of examples of what we can do with this. To touch on one of the points that Rodney just raised around this kind of, is one feed more real time than the other? Is, are things slightly delayed? I mean, again, you guys have, you people on the call have kind of understood this, and you know that there's published information about different tier ones that have taken the jump on people. They've realised that a feed has been slightly delayed. Their pricing is different from their two feeds. They've seen which one's kind of been delayed, switched over to the other, made a jump on the market, made their money. And that's kind of, some of that is published. I think a lot of that is not published and obviously goes under the covers. But it's, that visibility we keep on talking about, that visibility and awareness of how you're performing, not just, the historic view of the world, which is, oh, the market data is there, it must be right, because I've been told that, market data is always on. There is no just on off. To Rodney's point, there is There are times in the market where it dips. There are times when and they all dip at varying times. Understanding when that is and its behaviour and how to action that against that, that's where it kind of comes into its own a bit, I think. So, just to give you an example of kind of some of the things that we've been discussing. So, obviously, Geneos has the dashboarding capability. Again, what we tend to see with a lot of our clients now is a lot of these are for application support teams, just in the trading area, just kind of on a screen. There's a lot of data coming in here. There's a lot of critical touch points and critical areas and large volumes of data coming through. So how do we elevate that data into a simplistic view while giving you that kind of consistency and that kind of confidence in your market data? So this is a very simple example, and I think Rodney alluded to this earlier, which is we're using LSEG as a baseline feed, which is that white line across the middle. Now, just in this example, we're using, a very liquid instrument, just to kind of get an idea. We want to get something that's just, we're not too interested in the pricing, we're just interested in the kind of making sure we're getting regular updates and consistent updates. And again, here we've got, an example, XG, Bloomberg, and ICE feed against these. So this is a kind of quite a rarity. We've got 4 different feeds coming in, but it just kind of shows you that scalability. We can see from each of the providers what the different latency is and how they're comparing. Now here we're just giving that kind of absolute raw latency, but what we could do if we wanted to is to kind of show you the variance from your primary feed. So here you can see graphically how that works. Now, because it's coming into Geneos, all things Geneos, the notifications, integrations with your messaging systems, pop-ups on the screen here, integrations with your ServiceNow, your incident management system, all of this can be integrated with, and that's not a problem. Where the benefits will come is not only just seeing this data in real time, like you can see here, but once we start overlaying that historical performance and say, for example, based on the last 3 weeks, show me kind of how this variance applies, and I can only notify me when I'm, 1 or 2 standard deviations away from where I normally happen to be at that time of day. So it kind of gives me the context of how I'm performing, and is this normal behavior? And I think to understand your real-time data, you've got to kind of be wary of your historical data, and that in turn enables you to kind of start forecasting, the trends of if things are getting faster, thumbs up, your investment's looking well. Things going slower, you've got a problem. You need to speak to your providers. You need to understand where that problem is. So another example of this is if I'm looking at my instrument latency, I'm just getting raw latency again. These are, in this example, we're just showing you purely for, top 10 high liquid instruments. If I look at these charts, what I can start to see, I can see the currency that's here. I've just got an alert on here that's telling me if I'm above 100 milliseconds, but again, I don't necessarily have to have a static threshold there. I can say, let me know how far away from my normal expected behavior am I? How far I'm away from that expected latency. So again, this is just another example of when to Rodney's point earlier, is when I've got that data out, looking at the current value of a stock or looking at the delta where it is, looking at latency information. I've got derived information on here as well as real-time data. So I can pick all of that up and notify it as I want. And just kind of lastly, especially with what happened last week with NYSE, where they've had 2 major events, as an example with an exchange, 2 major events where by implementing a new piece of software, some of the, there was 40+ stock prices that they've, I think Rodney mentioned this at the beginning, which was that the variance on, well, he's going to talk to this about the variance on, what the delta is between different ticks. There's, the pricing went down 99.7% on 40 stocks. There was an automatic circuit breaker kicked in at NYSE. The market was closed. The market was out for an hour. Now, obviously that was very public on what was happening, and that had a knock-on effect to the S&P 500, the Dow Jones, and obviously the confidence in the market because they were down at the end of the day. Now, from your perspective, you know, if I've got a number of exchanges here, and NYSE was one of them, what we're trying to give you is that awareness that when you have a problem, it gives you that context of the problem. Is the problem an exchange? Is it a feed problem? Is it an exchange problem? Is it the connectivity issue? Is it my hardware on site? Is it my problem, their problem, network problem? Where is that problem? So first of all, we give you the indication and we give you that kind of up front and center. There's a problem with the exchange. You've got a problem. The next thing is that gives you an understanding of to pinpoint where the problem is. These, again, are just examples. These can be whatever you want them to be. We've just got a Bloomberg and an LSEG feed here, just as an example, and showing you that variance. But the key to it is that kind of pop-up, not just necessarily on a tick by tick to say there's a problem with this tick. No, there isn't. Yes, there is. It's that kind of the trending. How is it looking? Is it consistently? Is my Bloomberg feed consistently quick, faster than my LSEG? And we can do these on pricing or just on pure raw latency. Once I have that information, it's all well and good seeing things very specifically, so you can pull that out so that people are interested in the network connectivity and looking at, you know, the markets and how the latency is working. But how do I bring all that information together? Now here, if I look here, if I just give you this example here, you know, we're pulling together now a huge amount of information into one overview. So we've got the raw latency, which I showed you earlier. We've got the instrument latency, which we showed you, the exchange raw latency, all on one screen. And underneath, you know, at that bottom, as an example, and this is sometimes often overlooked, I think in our experience when we've worked with market data, is the contribution latency. If you're contributing back, how long is it taking for me to get that data, to normalize that data, enrich that data, package it, republish, and then potentially consume that data again? How long is that taking? Is it different with different feeds? Is it quicker or slower than I'm used to? You can correlate that. You can overlay that change control or improvements you've made to your investment to see if changes have affected that kind of contribution turnaround time. Again, this is just a simple example. What we do often find, and a number of our clients are using this now, which is they'll put a feed on there or an instrument pricing or some of their stock. On top of that, they'll start overlaying, show me my network performance, how my network's performing, how my infrastructure is performing, how my middleware is performing, and even, you know, we're getting also correlation between trade volume rates and trade volumes against market data and how the market's moving. So you can start to see that. You know, the charts that we're showing you, just examples. Again, you can push on there latency against volumes or against network performance to see if there's a correlation there. And by overlaying, by understanding behavior, you'll understand whether that's normal and that's kind of as it is expected and that's how it normally behaves, or if there's abnormal behavior happening which is affecting parts of your market. All of this data, just like we mentioned before, can be stored in the Geneos backend analytics platform. Just to be very kind of clear, to make sure we're on point here, we're not a tick store. So we're not storing all of the ticks. What we are storing, for example, the latency metrics, your derived metrics, your deviance, your percentiles, your standard deviations, all of that kind of variance, all of that information we can store, and you can do additional kind of calculations on there as well. So there's a lot of kind of things going on there, really.
Yeah, I think that's great, Dave. Thanks very much. I think the contributions latency there is very interesting as well. It's probably one of the use cases that we haven't mentioned in the previous slides, but this idea that, you know, I think as much as 70% of the data that moves around a bank or a sell-side institution can be their own proprietary data, you know, taking market data in, running some transformation and then publishing it back. In that scenario, you're almost behaving as your own market data vendor, right? And that's where you've got total control over your infrastructure, and knowing how that even is performing is very interesting to me, because that's my own market opportunity that I have control over. So one last thing we're going to talk about is at the top of this presentation, we kind of said that it's not just timestamps, it's not just latencies we can look at, it can be any other data field as well. And that means I can kind of go a little bit beyond just latency monitoring to actual thinking about data quality. And again, it's like, it's not just about absolute data quality, but maybe the relative data quality between feeds. So this can be achieved just by, again, sampling any specific field within a data packet. So it could be price, spread, volume, whatever else is within that market data information packet. And checking, I could check for missing fields, I could run statistics on top of it to see if there's anything which is mathematically odd, and just get a feel for how accurate that data is and how high quality that data is.
Yeah, I think the missing fields is a key one as well, right? Because obviously things like the MiFID come along, that kind of data quality and ensuring, obviously that's, while it's not normal behaviour, it happens, and you just need to be on top of it to ensure it, ensure that data's all there.
Yeah, absolutely. And so thinking about what this could be is, just to give some of the real life examples that we've worked with customers on. If there's a bid greater than the ask, maybe there's some kind of consolidation in the feed. But if the bid's greater than ask, obviously that kind of crossing the spread is an issue. If there's a one-sided bid, if there's a particularly high or low bid price, if there's a particularly high or low liquidity size, all of those things I can basically go in, report on the data fields, run some maths and be alerted to it. So just to drill into a couple of those use cases a little bit, this is what an example of crossing spreads might look like. So within the screen here, you can kind of see any of the data fields can be reported out. So some of these are just data fields from the data packet. You're going to probably want to pick a sample of instruments. You're not going to want to do this for every single instrument. But a sample of like highly liquid instruments that your company trades on. I can report out some of the information, then run some derived data on this. So some of these fields are derived. So you can see in this particular example, I've looked at the bid and ask, and anytime I get a positive sign, i.e. the bid's greater than the ask, I'm getting on the first line there, you can see for AAL, I've got a positive value which is telling me the spread's been crossed, and I can, as Dave said before, any sort of Geneos alerting to let me know that there's some issue with the data field. And Dave's just spoken quite a lot about some market events, so things like exchange failures or fat finger errors. This is about going kind of one level deeper than that. It's like, what if it's not a market event? What if it's only a feed event? Can I be alerted to the fact that I have an issue with a feed, which would, to all intents and purposes, be the same as a market event for me, but one that I could avoid by going over to my secondary source?
Yeah, and being notified, I think, is the key here, right? It's what is the problem is the first thing. I've got a problem. One, what is it? And then why is it? And that's the kind of important to know. The other thing to talk about here as well is, and this is where kind of getting that data to come into one area, is what this also does. And you can see here, this kind of like we've got a base feed and an alternate feed, and this could like any two feeds. Because we've got that data in a centralized area now, we can start comparing what the difference is between, which one is giving me the latest price. I mean, you'd hope that the comparison between these two bid prices is zero. But if it's a negative number, then obviously there's a feed, your base feed is slower than it should be. So, there's a lot of variance and kind of examples and use cases that this allows you to adapt to.
Thanks, Dave. And just to talk through a couple of other screens of some of the other examples, we've chosen not to demo this live because it's a bit of a fiddly one to demo, but here's the Blue Peter one we prepared earlier. So this one's looking at wide spreads. So again, I'm looking at the bid and the ask. If there's an unusually wide spread, could be a market event, in which case, fine, I've probably got other ways of getting alerted to it, but it might not be. Again, having a look at the standard deviations of the bid and ask and seeing what the standard deviation of spread is to be alerted for an unusually wide spread could be potentially an issue with the feed rather than a market event. And so looking at the skew there, calculating standard deviations, any other statistic is all possible once I've reported on that data into Market Data Monitor.
Yeah, and these examples of geo average spread, skew spreads. I mean, these are just examples of kind of different mathematical calculations you can put in the code. Again, there'd be development here. If you've got known kind of spreads that you're interested in, they can be added quite easily by yourselves. That's not a problem. Obviously, we can do them.
And then just final one, unusual prices. So again, just to, there's a little bit of nuance. Again, this isn't necessarily about market events, but about feed events. So understanding that there's been an unusual price movement might alert me to the fact that I need to fail over to my other source of feeds. You can see here there's some other kind of data. Again, there's just a few data fields here. So it tells you where my last quote is. We spoke earlier about stale data, so you can be alerted here to stale data. Also just lets me know how many kind of ticks in my sample. So it's something to think about when you're setting these things up, is the more liquid the instrument, the bigger the Hopal ticks, the more reliable the sample size, the more statistically important it will be. And as we kind of help our customers to set up, I think we think about the kind of instruments that really work for this, Dave.
Yeah. I mean, and look, this again, we're just giving you a subset, a tip of the iceberg really of some of the things you can show. What we've also found is some people don't go down to necessarily the instrument directly. They'll go to the indexes. They want to see how the FTSE's doing, how the S&P are doing, and just kind of break it down regionally, just to kind of give you an idea of how the markets are moving as well. And again, we'll continue to build on that and add in more information. But all of these kind of derived calculations, historical benchmarking, performance-wise comparisons, once you've stored that data, kind of like how you use that data is yours now to use of how you want to see it and the shape how you want to see it, to kind of understand your data a lot more and a lot richer.
Fantastic. So I think I saw a couple of questions already come in, but I'm going to hand over to Angelo. Angelo, do we have a couple of questions? I think I saw one at least come in.
Yeah, we got a couple of questions. The first one, how easy is it to integrate market data feeds into the solution?
Yeah, again, one of the things we're mindful of, there is a lot of complex ways of doing this. For market data, we already, we've got a number of industry standard adapters out of the box where we worked with, these vendors. We work very closely. In actual fact, ITRS was originally formed as part of for market data. That was from its inception nearly 30 years ago. So it's very easy just to kind of hook onto that market data feed. We don't require things like any hardware or optical taps or any kind of network related kind of connectivity. It's a very simplistic, well documented configuration just to kind of hook onto that feed as like a subscriber or just to get that data feed in. So that's a long-winded way of saying it's relatively straightforward and well documented.
Great, thank you for that. Another question, how long can you store the data for?
Again, that's a very interesting point, because we obviously know with a lot of providers you get kind of a list of data, and it's obviously the big question is how long do you want to store that data for, how relevant is it? But with the Geneos Analytics back end, you can store the data for as long as you like based on your storage. Now there's two key elements there, and we can help you with this. It's very straightforward to do the calculations on it. But when we store the data, we do not conflate the data. So we don't, for example, because that obviously would be detrimental to your performance and to your comparison, we keep the full fidelity of the data of when you stored it. So we don't, for example, say if it's greater than 3 months, conflate every 5 seconds to every minute, and normalize, and average that data out. We keep the full fidelity. We've got a very high compression ratio of getting, of storing that data, an incredibly high compression ratio. So we can store it, you can use it. There's no additional cost for storing or for keeping that data for extended periods of time. It's your data. So long as you've got storage capacity, which we can help you with, giving you sizing of what the requirements are over time, based on the the data you're consuming, you can store that data for as long as you like. So there is no kind of issue with that at all.
Great, thank you for that. Another question, is it possible to create a custom adapter for my internally published data? Yep.
So we do, out of the box, we do provide, as I say, a number of the most common kind of feed adapters. yes, we can create. We can either create the adapter for you for new feed adapters that we don't have. If you've got your own internal feed, we can hook onto that as well. You can write it yourself. We're very much a company now that kind of works. If you want to do these kind of things, we can give you point you in the right direction, looking at how we did it, how we've done it previously, so you can kind of mimic that and adapt it to your own ways. Or we can relatively quickly provide a new adapter for new feeds that are coming. And I think,
yeah, I mean, we even, the market's constantly changing. We try to stay as close to the market as possible. We've worked for a long time with the various guises of Triarch, RMDS, TREP, RTDS, but when there are new entrants into the markets, like a Markets II, we will quickly get customer requests for that and respond to market demand. So generally, the off-the-shelf feed handlers cover, I would say, 99% of what people need. Every now and again, people might want something custom, which we're happy to work with them on.
Yeah, and the important thing here is, the first thing is to look at our documentation first to see what we have off the shelf. That's the first thing. I think secondly, working with your account manager and your sales engineer, understanding, for example, Rodney mentioned the Markets IO, for example, working with us to understand what's on our roadmap, just in case, there is something that will cover what your need is. We can give you that information, rather than, just looking and saying it's not on there, it's not on your website, therefore it doesn't exist. Talk to us, reach out to us, contact us at support or your account manager. We're more than happy to kind of give you that updated information.
Wonderful. I think that is all the questions we had. I'd like to thank everyone for your time this morning. Thank you very much. We will be sending you some information in the next couple of days about the solution, in addition to the webinar recording. But from us, that is everything. So thanks, everyone.
Thank you very much.
Thank you. Bye-bye.